Here is your New Sky Bay end of week report for Saturday the 23rd of September 2023. So this week in markets we saw an enormous sell-off in stocks in quite a big way. We saw Treasury bond yields spike to levels last seen before the global financial crisis, and we had 3 central bank decisions from America, the UK and Japan. So there's plenty to get into in this video. If you want to get caffeinated, go make yourself a coffee, take out a pen and paper and take notes. Please use this information or completely disregard it as you like. Let's get into it. So to start with the big fish, let's turn to the US markets and the US economy. I did have a video in the week just after the Federal Reserve's decision to hold interest rates, and I went into it a little bit in that video. But to give it more context, we're going to go over it again because it had, as you'll see, an absolutely enormous effect on bonds and on stocks, and of course on currencies as well. And the big news, of course, wasn't that the Federal Reserve held interest rates steady, although that is good news, depending on which way you look at it. The news wasn't what happened in the press conference afterwards. Of course, the big headline was the update to the FOMC SEPs. And as I said in that video, those are essentially the FOMC members, so members who vote on the interest rate decision. They're loosely projected economic forecasts for the US and the influence that has on their interest rate decisions. So they loosely plot out what they call it dot plots, where they think the economy's going and what they see the Federal Reserve policy doing to match that. So I went into that briefly in that video in the week, but to go over it again, the Federal Reserve delivered an enormous upgrade to their forecast to the US economy. They doubled GDP expectations for this year. They improved their sentiment on the labor market, meaning they think unemployment will be lower. So unemployment lower, meaning stronger labor market. They kept PCE inflation readings basically the same. But the big headline was, of course, they saw interest rates staying 50 points higher next year and the year after. So for 2024 and for 2025, they saw, as compared to their June projections, they saw interest rates being 50 basis points higher, which delivered an enormous blow to market expectations of what Fed policy will be and where they see interest rates being in the future. So to understand what all of this means for markets, what you have to understand is that higher interest rates are basically placed on the economy by central banks in an effort to combat inflation. So as inflation goes up, the central banks raise interest rates to try and combat that inflation, to bring it down. And the Federal Reserve is essentially signaling to markets, we see US economic growth being so strong that inflation is going to persist. Therefore, and ergo, interest rates need to stay higher for longer. And I think I'll have to make a separate video on how interest rates work, but what you have to understand is that very simple equation. High interest rates is bad news for the economy. That's basically what you need to understand when you look at this data and this report coming out. So the Federal Reserve upgrading its expectations for interest rates really hammered stocks down this week. And I'm going to go into the market recap now, and we'll go across to my screen here. So here is the outlook for US markets we'll get into here. All this data is from the Wall Street Journal, available for free on their website. So here's the 5-day view. So this is the price action on the week for the S&P 500. And around here is when, so Wednesday, 2 p.m. Eastern was when the Federal Reserve announced the rate decision and their new forward projections. And you saw just this enormous sell-off in equities as investors priced in this upgrade to the interest rate decision, expectations, And that just dominated the narrative this week, as you see, as stocks just continue to fall off. Exactly the same thing with the NASDAQ. You see Just an enormous fall off this week as investors start pricing in this new Federal Reserve expectation. And if we can go across here to the bond market, you see bond yields had an enormous boost this week. Just that enormous spike there, taking some bond yields up to highs last seen just before the global financial crisis, just to let that sink in a bit. So absolutely huge spikes in bond yields, stocks taking a big hit as markets react to the Federal Reserve telling people we're going to be we believe, let's phrase it like this, the FOMC members believe interest rates are going to have to stay higher for longer than previously accepted. And this is me just showing you the bond yields all the way down the bond yield curve, all the way out to the 30-year. So that was the big headline coming out of America, or the United States, I should say, this week. The Federal Reserve sees interest rates being higher, stocks sold off, bond yields climbed on the news. So here's the S&P 500 on the daily, the intraday chart, 5-day, coming up here. And so to take it across to a quarterly view, here's how this looks on the S&P 500, right? So this enormous drop here is this week. This is the influence the Federal Reserve has on financial markets at the moment. So the stock market is now, in terms of the S&P 500, it's similar across the Dow Jones and the Nasdaq as well. It's basically back to where it was at the end of June. So stocks have really sold off here, and a year-to-date view gives us the broad picture here. We're in an enormous sell-off, a bit of a dip. And just to explain what's happening as you look at this chart, let me go over to the quarterly again. This is investors getting hopeful that inflation is coming down and the Fed can finally cut rates and will be looking good moving forwards. But slowly and surely you see, with each strong GDP reading coming in, with each strong inflation report coming in, you see how markets are just slowly losing their optimism and selling off. And then finally, this week, when the Fed said, yep, interest rates, we see them being higher, you're just seeing how markets are just really fighting to get back up, but slowly pricing in this interest rate outlook. So that's how we are looking on the big picture on the S&P 500. Nasdaq is similar. If you look at the Nasdaq on the quarterly, it's basically the same, except we're even lower than we were at the end of June. And to do the same thing for the bond market, here's how bond yields are looking on the quarterly view. So you can see as stocks are sort of slumping a bit on this inflation growth interest rate move by the Fed, or expectation from the Fed, you see how bond yields are climbing. And this is true all the way down the yield curve, from the 1 year to the 2 year. See, this is the quarterly view on all of these treasury bonds. The yield is climbing as the Fed is saying interest rates are going to be higher. So to stick with the 10-year, which is a bit of a benchmark for markets, is the year-to-date view and the yearly. So you see how these yields at the moment are definitely climbing on these hawkish Fed expectations. And this is important because as bond yields climb, stocks become less attractive. Because if bond investments are starting to pay more, it means there's going to be less investor interest around stocks and other risk assets, as they say. So these bond yields climbing is a big deal. Not only because it shows markets are really taking the Fed seriously when they say these things about interest rates, or when they signal them, but it's also important because as bond yields climb, it basically makes stock investments less attractive. That's the general theory anyways. So that's how bonds and stocks are looking. Just to quickly come across the currencies here, here's how the euro performed against the dollar this week. You see, again, this enormous peak here, and this absolute tumble was when the Federal Reserve said, yep, interest rates are going to be higher. So that's your update on what moved markets this week in the United States. and also given a more contextualized understanding of how that fits into the big picture. So stocks are hitting a bit of a malaise as investors are a little bit cautious about, the Fed keeping interest rates higher and bond yields are climbing, making stocks less attractive and other risk assets, as they say. So that's what's moving in America. To move on to what happened in the UK, there was quite a big week in UK markets as well, particularly in terms of the macroeconomic outlook. So we had a huge inflation report earlier in the week, and then on Thursday we had the Bank of England rate decision. And in that, the Bank of England, so Andrew Bailey and co, voted to pause interest rate hikes in the United Kingdom. And I did a brief short on this earlier in the week, showing the initial market impact, and we're going to get into it a little bit further in this video today. So first, we need to go into the inflation readings coming out of the UK, and you need to understand how this fits into the big picture, because the UK is not looking good when it comes to these inflation readings and growth prospects, and markets are definitely worried. And so I'm going to go across to my screen right here and we're going to have a look at it together. So here is the data that was released on Trading Economics at 7 a.m. again UK time on Tuesday. So quite early in the week we had this inflation report, and out comes the CPI readings, the core CPI and then PPI as well. But the big one is this headline year-on-year CPI inflation reading. And it was good news for the first time in what seems like forever for the UK. Inflation was expected to come in higher than previous, so 6.8%. It was expected to come in at 7 or upwards, but instead it came in lower at 6.7, so still ridiculously high, well above the Bank of England's target, still immensely difficult for people living in the UK in terms of their price pressures, But good news for markets because it came in lower than expected. So here's how this looks on the year-on-year chart. Here was this enormous 11.1% peak we saw towards the end of last year. And you see how it's slowly coming down back to where it's finally under 7% at least, you can say. So this reading here was a good one in its context because it came in lower than previous and lower than expected. So this is fantastic news for headline CPI. We also had the core year-on-year reading. And this coming down is the big one, because this is what central banks look at far further. Central banks watch this more closely, I should say. And you see it was picking back up at the start of this year, which got the Bank of England freaking out, where they had to deliver more interest rate hikes, and now it's finally coming down. So this is all fantastic news on the inflation front for the UK. It's not perfect, it's not what you would want to see, but it's good news compared to what we have seen. And on Thursday, the Bank of England voted to pause interest rate hikes. So the Bank of England has been hiking their interest rates for, at this point, 2 years. And this week was the first time they voted to pause, which is great news because it means what markets assume to be the end of monetary tightening, meaning interest rates hiking. It might not be the pause, as Andrew Bailey signalled, but at least for now, the Bank of England has stopped hiking its interest rates. And coming back to the simple equation I gave you at the start of this video with the Federal Reserve, interest rates going up, bad for the economy. That's a simple equation you need to understand. So this might seem like good news, right? Inflation is finally coming down in its context. The Bank of England is stopping its rate hikes. This might seem fantastic. But when you ask the question why, things become a little bit more concerning. And what the UK is finding itself in now is concerns about economic growth. Right? Inflation's coming down, but is that because the inflation pressures have eased in the economic sense, i.e. supply chains and energy costs coming down? Or is it because the economy is contracting? So this is what has people a little bit on edge with the UK economic outlook. Inflation is coming down, which is fantastic, but there's just a few concerns about economic growth. And we had another key piece of UK data coming out in the week with the retail sales, which climbed 0.4%, which is a good reading showing positive growth, but it was still less than expected at 0.5%. So there's just some concerns around the United Kingdom economic outlook and ergo its markets. People are slightly worried that although inflation's looking good, growth might be coming down with it, i.e. recession. So this is what you need to bear in mind with the UK outlook. So just to briefly go back to the UK market outlook, here is the price action on the FTSE 100. So here's how UK blue chips have performed this week. You saw climbing on the good inflation readings, or the good inflation reading, I should say, on Tuesday. Fantastic news. UK markets are of course influenced by the Federal Reserve and the US outlook, so an enormous drop off here. The retail sales figure coming in and lifting markets back up. And so this is what we're seeing in UK equities this week. Just a little bit up and down. Some slightly positive news from the UK, some bad news from America, at least in terms of stock outlook, or equity outlook, I should say. And the week, the FTSE basically finishing just a tiny bit lower than where it started earlier this week. But some good positive news, and then some bad auxiliary factors such as the Federal Reserve. And to give it more context, here's how it looks on the quarter. You can see how it is ultimately up as compared to the US benchmarks, excuse me. And this is all on the hopes that the UK outlook isn't as dreary as people once thought it to be, with inflation finally coming down, retail sales staying positive. There's just, of course, the growth outlook that's spooking people a little bit. So here's the FTSE 100 across the quarter, and then year to date is how we are. So to come across here to some foreign exchange markets, just to look at the pound dollar, or cable dollar as they call it on trading floors, here's the price action on the week. So this is the UK currency against the US currency, is the exchange rate. And you see how it's clearly going down this week. And what's causing this is both outlooks are confirming this trend. So the UK has inflation coming down and the Bank of England pausing rates, not really giving much guidance on where they're going to be. So that's weakness in the pound. And then you compare this with the other side of the foreign exchange, or the exchange rate, excuse me, the dollar. You have the Federal Reserve saying, yeah, we see interest rates going up. We're bullish on the US economy. There's a lot of strength here. The labor market's strong. We see rates staying higher for longer, which is good for the dollar in terms of its value against other currencies. And when you match this compared to the inflation rate dropping in the UK, recession fears really mounting, this is what you get. You get a strong downtrend on the week. So this is all backwards looking, don't forget, guys. This isn't any trading advice. This is simply to understand why markets are moving the way they did this week. And to give this more context, you see just a clear downtrend as people are thinking, yep, the US economy is going to be so much stronger in the future. Interest rates are going to have to stay higher. And this is what you get on the quarter. So this is the foreign exchange price action over the last 3 months on the cable dollar. So that's an update on the US and the UK outlook looking forwards. The other big news that happened this week was in Japan. And what happened was we had a big inflation reading coming from out of Japan to have a look at an update on the inflation projections and situation in Japan. And we also had the BoJ's interest rate decision. So I'm going to go across to my charts or onto my screen here and show you what all of this looks like. So just after midnight for us here in Europe, and I'm not sure exactly how that equates to the US time zone, we had this big Japanese inflation report come through. So this is all the big inflation readings come out for August. And the big figure is, of course, the headline CPI. So to come across and show you what that looks like, here's how it looks over the year. So these are all the inflation readings over the year. And you can see how it's ranging between 3.2 and 3.5 this year. So it hasn't gone down, it hasn't gone up. It's very much kind of stuck in this position right here. And what Bank of Japan watchers are looking for is for inflation to go up. Excuse the voice break there. They want to see inflation going up so that the Bank of Japan can finally, after decades, increase its interest rates. All right, so that's what happened first thing Friday morning. And then by 4 a.m. UK time, the Bank of Japan announced its interest rate decision, which looked something like this. They maintained it a negative 0.1, so minus 0.1% interest rates, as compared to other central bank state stances, which are close to, 5.5%. And this is how the Bank of Japan's policy has looked going back to November 2022. It's also how it's looked going back to 2019, and it's also how it's basically looked going back to 2016. Whereas before, it was only at 0%. And if you go back 25 years, you can see basically since the 2008 crash, it's basically been close to zero. And this is all because the Japanese economic outlook has seen this, what some economists call the ice age of stagnation, whereas Japan's economy is barely growing and inflation isn't growing with it. So since 2010, interest rates in Japan haven't been above zero, which is big news for markets. Let me show you a chart here. Let's just have a look at the 3-year. This is the view of the exchange rate between the US dollar and the Japanese yen. And you can see here, as the inflationary cycle begins and the Federal Reserve finally kicks in and starts hiking its interest rates, compared to the Bank of Japan, which kept its interest rates at negative 0.1%, the US dollar has just climbed and climbed and climbed and climbed, and this week has been no exception. This is the price action on the week. As the Federal Reserve said, we're going to be hiking interest rates. You just get this another lift, continuing this bull run of the dollar against the yen. And what's driving this exchange rate differential is very much the different stances both central banks are taking. The Federal Reserve is bullish on the US economy. It's hawkish in its monetary policy stance, meaning they see growth being strong, they see the economy, they see the labor market being strong, and they're saying we're going to have to keep these interest rates higher, which is good news for the US dollar, makes it very, very strong in fundamental terms, as compared to the Bank of Japan, which is maintaining this dovish stance to monetary policy, saying, yeah, we're not going to be changing our negative interest rates anytime soon. And so that's what the yen is looking like at the moment, and most of the yen charts look just like this. So there is your end of week market report. What's been moving markets this week, what to consider, and how to look at the charts, what fundamentals have been driving prices. Tomorrow I'll be updating a forward-looking report, a briefing for what's coming up next week. But thank you very much for watching if you made it this far. Please do consider subscribing if you enjoy this content, or if you find some value in it. I will be posting videos like this every single Saturday, reviewing the week been, and every Sunday I will be doing a video reviewing what's coming up in the next week. So thank you very much for watching, and good luck.